really I hope today was going to be about giving you a bit of background information around constructing resilient portfolios. I'll do it in the context of ADIG, which is the Diversified Income and Growth investment strategy, which we run for pension funds and institutional clients, and now we have it produced through an investment trust format. And hopefully we'll have the type of questions as we go. So ADIG, as we call it, is an investment company that seeks to provide two main things: stable, dependable income over the long term and capital growth. And do that for a globally diversified multi-asset portfolio. Now, multi-asset portfolios have different definitions, but this is a portfolio that invests across the full spectrum of public market and private capital market. And so before we get into the portfolio, I thought what we'd do is just go through a little bit of history, a little walk through time, because portfolios have evolved quite a lot over the last 50 to 80 years. And the interpretation of portfolios, even markets and conditions that we run have evolved in time. So in a whistle-stop tour, Harry Markowitz wrote a paper called Portfolio Selection, which introduced the concept of the efficient frontier, which many of you may have heard of, which is the combination of stocks and bonds, depending on your level of risk, which will be able to optimize depending on your time frame and horizon. Now, in the 1920s, stocks and bonds and mutual funds were available. In the 1960s, money market vehicles became an accessible vehicle. So as we went through the 60s, William Sharpe created what was described as capital market pricing for equilibrium, was really building upon Markowitz of work to be able to say, well, they have a whole bunch of different factors. One of those factors is in terms of risk that can be built around that portfolio, and coined the Sharpe ratio, which is a common metric used to describe risk and volatility. As we move through to the 70s, Eugene Farmer came up with what is commonly known as EMH, the efficient market hypothesis. Now, this also coincided with electronic trading and index funds, so market information was transmitted quickly to the market and disseminated to the pricing of stocks and bonds. So the EMH portfolio, alongside the capital asset pricing and risk portfolio construction, really became the foundation of asset allocation into the 70s. And the 70s also brought together the Black-Scholes model around option pricing. It brought arbitrage pricing theory, which was once again foundational based on Sharpe's work, to build portfolios. So as you can see, the instruments were evolving quite significantly. And the 80s were quite a turbulent time. We went through the stock market crash in the 80s. And Robert Shiller's work around market volatility really brought together what we describe as the foundations of behavioral finance, which around how behavior in stock markets can result in volatility and ultimately stock market crashes and beyond. As we get through to the 90s, we started looking at factors and factor risk. This was also through the inclusion of private equity, the small cap investing, and global investing more broadly speaking. And so the French three-factor model really decomposed two things: the ability to look at certain factors such as small cap, value, growth, and momentum, and really it's foundational when we think about quantitative investing as we see it today. So quantitative investing on liquid assets, and now moving into the alternative era where private equity became mainstream in the 1980s. David Swensen was probably the most famous, manager of Yale's endowment fund, and he wrote a book called Pioneering Portfolio Management. And in the 2000s, he brought through this idea that bringing through alternatives, which included hedge funds, venture capital, private equity, infrastructure, and the theory of active asset management, would generate higher returns. And through this time, and all the way to the detail, what happened through economic environments, where we went through high inflationary periods, went through wars, we've been through periods of high degrees of uncertainty, and all of these portfolio metrics were designed to really try and provide comfort for investors trying to go through a long-term investment process. And as we get into the 2000s and beyond, we see the ETF markets or the active to passive shift, and a broad range of alternatives from 2000s. So we've seen commodities, derivatives, digital assets all coming to the fore. So the backdrop of investing has really changed quite a lot over the last 80 years, and modern portfolio construction has had to keep up to deliver outcomes of fine. So if we look at the subsequent changes to portfolio construction, what you might have described as the 60-40s portfolio that was invented in the 1950s through the optimization that Markowitz and Sharpe really transitioned to what we describe as sort of equities and bonds portfolio with a generic basket of alternatives. And where we get to today is two things: really looking at risk and all the risk premia and all that research that was put together to say that actually there are a whole lot of different asset classes that have discrete characteristics. And a modern portfolio construction has liquid equity, private equity, real estate, infrastructure, private credit bonds, and alternatives such as hedge funds or even digital assets. So what does that mean in the context of building portfolios for retail investors? So asset allocation in terms of long-term investors have really evolved quite significantly. And I've highlighted two different types of investors here. So UBS Private Wealth is one of the largest private banks in the world, probably even bigger 2 weekends ago after they've taken over Credit Suisse. But for their long-term growth portfolios, they build portfolios that involve both public and private markets. And inside of the private markets portfolio, including things like private equity, private debt, venture capital, and alternatives such as hedge funds. CPPIB is the Canadian State Pension Fund, and it puts out 21 billion Canadians that have assets of about 350 billion sterling. And they look after long-term interests of the retirement community in Canada. One of the most established asset owners is the sophisticated asset owners. And they have a portfolio that's split up of both public and private markets. For their private market portfolio consists of roughly about 31% of private equity to generate these long-term return growth, as well as infrastructure assets, alongside the fixed income and equity assets. So when we look at the ADIG portfolio, we have very similar characteristics. We're trying to provide long-term returns with the highest maximum return potential while trying to minimize the risk of loss. And so when we look at abrdn's suite of assets or ADIG's suite of assets, you can see that the mix between public and private is very similar, but we've actually got the additional target or outcome objective to deliver more income in the portfolio. So we're really shifted more to fixed income, credit, and cash. And within the private side, we're looking at things like infrastructure and private credit to provide high degrees of income. But roughly, we have a 50-50 split between income and capital growth. So if we take that split and try and break it down, let's explore the portfolio in a slightly more segmented way. So the portfolio is actually broken up into probably 13 different components, which sounds like a lot, but actually we'll talk about that in clusters. But at ADIG, as it says in the name, is diversified. What we want to make sure is that we're not dependent on any one single strategy to be able to deliver the objective. To deliver that capital growth over the long term, what we need to do is be able to make sure that all of the parts in the portfolio can work collectively together. So we've got cash, we've got emerging market bonds, we've got asset-backed lending, we've got renewable energy, we've got real estate, we've got private credits, we've got social and economic infrastructure, schools, hospital, transport assets, development properties, and a small amount of private equity in the portfolio. And all of these together are working harmoniously to try to deliver the outcomes. So if we rank them in terms of their buckets, the way to think about ADIG is really 5 different baskets. We've got 11% of the portfolio in described as cash and defensive assets, cash and money markets. We've got 28% of the portfolio in high yield fixed income. That's looking at fixed and floating rate cash flows from lending to government, to countries, or to corporates, both on public and private. We've got what we describe as real assets, which are inflation-linked cash flows, which are from generation of energy around the world, social housing, concessions that we get from governments for schools, hospitals, and transport assets. And what we describe as diversifying opportunities. Now, these are specialized income streams such as healthcare royalties, user royalties, specialized assets, so shipping, litigation finance, and owning private markets managers. And what we describe as equity growth. So that's both public equities, private equity, and included development real estate here with the type of risk, but about 20% of the portfolio. So in these 5 buckets, that's what generates the return that comes out of ADIG. So just to bring it to life a little bit, so this is the I-77 toll road in North Carolina in the United States. It's invested through a program that we have called ADIG Global Infrastructure Partners 2. It's the main arterial route between into Charlotte, which is one of the main cities in North Carolina. And we first made this investment in 2018. We invested through its completion during COVID, and after COVID restrictions were lifted, we had significantly higher revenues from the amount of traffic going up and down this main arterial route. And we got an offer for the assets from a local buyer, and we sold this for roughly about 60% return, or 3.5 times our invested capital. That capital came back to funds being reinvested again. So a very core, stable asset in the private market world, alongside our listed little base, delivered a very strong return. On the other side of the equation, when we talk about private equity, this is an example of Sticks and Sushi, which is something you may have visited. If you haven't, it's a originally started in Copenhagen, and they reinvented sort of the yakitori experience. As expanded throughout Europe. There's 4 locations in London now. I think one Covent Garden if anyone wants to go visit this afternoon. But basically, strong management team, track record, growing stores, and through COVID, actually changed their business model and delivered performance. And at the end of 2022, we sold this asset for 2.5 times the amount of money invested and generated a 60% return. So once again, delivering higher returns on specific assets within the portfolio, which can then be reinvested for income. Now, the ability to be a multi-asset portfolio is quite important to us because what we can do within each of the 5 steps is that we can adjust the portfolio as we move to different market conditions. So if we think about the last 2 years, which have been particularly volatile, I think everyone's sort of trying hard to forget how difficult it was during the pandemic period. But in 2020, as we were going through that pandemic sell-off, what we really needed to do was to de-risk the portfolio, to make sure that we have dependable, reliable income streams. And we did that by de-risking the credit portfolio. So we were worried about defaults in the portfolio, so we took credit risk off the table during that early period during the pandemic sell-off. As we were working through the pandemic sell-off, we needed to make sure that we just created some cash flows in the portfolio that could be more resilient because of near-term volatility. So we diversified the private markets portfolio across a range of infrastructure, private equity, private credit portfolios, and we did that through primary investments into the ground, and as well as also taking secondary positions of existing assets into a trust. Now, at that point, we went through the tech sell-off, and that was just before the Ukraine crisis, so we thought we'd double down on prices, but there were more to come. So what we did is we looked at inflation-linked real assets, the more infrastructure, things that were linked to CPI, and that allowed us to essentially deliver more income back to the portfolio in a more certain manner. Now, as we got closer to the end of the year, we had the UK gilt crisis, to the ADIG crisis that happened after the mini budget, and as a result of that, we really looked at adding defensive equities to the portfolio. So we sold out UK mid-cap positions and we started raising more cash. We talked about the I-77 Toro, we sold that asset and collected quite a lot of cash in the portfolio. So our increasing cash and defensive assets, and through making these tactical decisions and dynamic asset allocation decisions, we were able to pay all the little red dots was paying somewhere between a 6 and a 6.5% cash yield back to investors through that period. And as you can see, the red line is not particularly volatile. That's the NAV of the trust, which didn't deteriorate at all over that period. We actually generated 15.4% total return over those 2 years at a Sharpe ratio, going back to William Sharpe, looking at the risk and reward of the portfolio for 0.62, which is very strong relative to our peers. So where do we go from here? The road was sort of bumpy at the time, and it's going to continue to be bumpy. So if we looked at 2023, I describe it a bit like driving on an icy road. You just have to be really careful and be really vigilant. We don't really know what's going to be on corners, but we'll sort of give you a bit of context of what we're thinking about. So if we think about the road ahead, market sentiment is shifting at the moment based on what the central banks are going to do around the world. And I think near-term volatility would really come from more macroeconomic drivers, the things that are kind of specific to asset. But if market sentiment shifts from a soft landing to a recession, we'll then be seeing a sell-off in risk assets and therefore more volatility in the equity market. If the Fed see that as a decision that they can release their ability to hike interest rates further, that would see the market being a bit more exuberant, and we saw that in the last couple of days, leading to a rally in risk assets or equities. And ultimately, the Fed decides to go the other way and try to combat inflation more heavily, with the accelerator back on in terms of interest rate hike. And we've already seen what that's done to the banking market. So all of these things are things that we're going to have to course correct. On the flip side, geographically, Asia is now reopening, and the China expansion will hopefully offset a little bit of developed market weaknesses. But inflation is still a key issue around the world, but central banks are trying to combat that. So whilst inflation remains stickier, that's really going to prevent central banks from reducing interest rates back to the levels that we've seen before, back to zero. So we're going to see where peak inflation gets to, but really these are going to be the major drivers in the near term of 2023. So we're going to have to see what that means for our assets. In order to navigate this, you need to look at your assets in a forward context. So on the left-hand side, basically we've got cash assets that are more certain with low economic sensitivity, and on the right-hand side, you've got assets which are less certain around their valuations, but provide growth potential. So you've got to live with the volatility. So when you're building the portfolio, it's really about trying to tilt the portfolio into where you think the risk tolerance would lie from economic sensitivity all the way to cash. Now, and then reduce risk in the portfolio, you reduce return. So if you're trying to generate higher returns, you've got to find the mix of assets that can do that longer term. So as I described before, the buckets that we're talking about, cash and defensive, high certainty, money markets, cash, high yield fixed income, fixed and floating rate from company of governors, real assets, quite certain around the cash flows, but volatile in terms of valuation, diversifying opportunities and growth equity. Those are the things that start driving higher growth in the future. So if we overlay the ADIG portfolio to this is how we stack up at the moment. We've got 65% of the portfolio in resilient cash flow assets. So cash and defensive, high yield fixed income, and real assets. 65% of the portfolio is going to deliver a steady stream of income back to investors consistently, irrespective of market. Those cash flows are contracted and subject to major defaults or anything going on with the assets themselves. Those income streams are very reliable. As we move to more diversifying and economic growth, we can pivot to growth when market opportunity limits become more conducive. So ADIG is in a really good position to be able to provide strong resilient cash flows. So let's talk about that in terms of returns and where we need expected returns. So the numbers are quite small, but you'll get a copy of this on the website, I think, later on, so you can go through in detail. But if you look at each of those individual buckets, we can see that actually there's quite a lot of yield being generated in this portfolio, as I described, from this more certain, low sensitive type of assets, generating somewhere between 2 and 7% on the portfolio, and on a blended basis, on a weighted average basis, delivers about 5%. As we move to total return expectations, cash, as you can imagine, will be around 2%, but our high yield fixed income should return its income yield, so 7%. Infrastructure assets could return somewhere between 7 and 10%, depending on the type of risk involved in them, but we're expecting around 7%. Natural resources and real estate around 4%, much lower at this point in the cycle. And alternative income that was generated from the specialized assets should be around 8%. And so on a blended average, we're expecting to deliver our 6% targets net of costs. But a lot of people are concerned about valuations on the private side. So we try to I guess, contextualize that in the context of valuations. Now, the valuation frequency on public side is daily because it's traded and quoted. While on the private side, we still get information on a quarterly basis. And so this is about being able to look at the observable discounts in the markets, being able to see what the market's pricing that, and on the basis of where we think that investors are pricing the remaining parts of the portfolio, ADIG should be trading at about a 11% discount. At the moment, it's trading at about 25% discount. So we think there's tremendous value in the type of cash flows that we've got available to us. Compliance is not whatever, so you get through that on your way out. And just where we see value in 2023, we've got special situations debt where we see the banking crisis. We think that we've seen opportunities coming out of that and secondary private equity. Real assets and inflation-linked assets and real estate disruption will play out over the next 12 to 18 months. And on the liquid side, this global desynchronization, looking at China and Asia versus developed market. And a fixed income, we still favor defensive fixed income assets and local market currency. But to that, wrap this up. So I think we'll wrap it up here with sort of why ADIG and why now. So I think I've talked about really sort of the portfolio construction process over time. The brilliant thing about ADIG is that you don't have to do all the research. It's already packaged in a box for you. You don't have to be part of the UBS private client network, nor do you have to be a Canadian pensioner to get the same asset allocation. You've got an institutional grade resilient portfolio that is incredibly attractively priced today, with down to 6.8% cash yield. Actually, I think that's come into 6.5 the last couple of days. And we're defensively positioned to weather turbulent times. So with the ability to pivot to growth when markets turn around, towards the back end of this year or in next year, ADIG will be able to provide strong growth potential as well as income.